Hello everybody and welcome back to our channel Anything Under the Sun. For today's video, we have episode number 3 from the Money series. Over the next few episodes in the Money series, we will have a look at different asset classes that are available for investment, and for today, we will focus particularly on mutual funds. So before we start today's video on mutual funds, what are assets and what are these asset classes? So we have discussed in the earlier video that there are multiple assets where we can start our investment journey, and we can always diversify across these different assets that are available. And all of these assets are grouped into multiple classes depending on the similarities between them and the comparable nature of various features. So these are called as asset classes, and there could be multiple types which we will look at currently. So in the past, we have had a few asset classes which have been limited to cash and cash equivalents. Then we've had a few asset classes which offer fixed incomes, and then there have been equities which are usually linked to the stock markets. Over the past few years, we have had further asset classes being added to this mix, which now contributes the new mix of asset classes, which in addition include commodities, real estate, futures and derivatives, and also very recently cryptocurrency. We also have a few others, like we have heard of VCs, which are venture capitalists. Then we have collectibles, which could involve rare antique items and a lot of these expensive things that you can own and also trade in the future. These classes can also be split depending on how liquid these assets are. Basically, it means that if you want to quickly convert some of these assets into hard cash, if it is really easy and convenient to do it, then it becomes a liquid asset class. If it's not so easy, not so convenient, and if it takes a very long time for you to convert them into hard cash, then it becomes an illiquid class. Again, would like to re-emphasize on the importance of diversification here. So that is one important reason why we should understand most of these asset classes, so that we go and invest in not just one of these asset classes, but at the same time in multiple classes, so that we diversify our portfolio and also try to balance our risk and the reward ratio. With this background, quickly moving on to mutual funds. So most of us would be aware of what mutual funds are, but for people who are not really sure, mutual funds are basically investment instruments wherein they try to pool in money from different people who are willing to invest into these mutual funds, and this money is then channeled into multiple securities like stocks, bonds, money markets, and others. So basically, once you invest in a mutual fund, it offers you access to all of these securities and assets. So what you get in return for the amount that you invest in these mutual funds are basically units, because you are one among the many people who will be investing in these mutual funds, which means that you will get a proportion of these investments in the form of units depending on the amount that you're paying for. And proportionally, your earnings, which could also be profits or losses, are also proportionate to the number of units that you own in a particular mutual fund. Mutual funds are a form of diversification in themselves, because as you know, every mutual fund house or most of the mutual funds, they invest or they put your money in multiple different asset classes. So if you are investing in a mutual fund, which itself means that you are trying to diversify your investment. So there are multiple types of mutual funds that are available, the most common ones being equity, fixed income funds, hybrid funds, index funds, money market funds, themed funds, etc. A quick look at what these different funds are. The most common ones being the equity or the growth funds, which are actively managed funds. Most of these are actively managed funds, which means that there is a fund manager who tries to actively rebalance your portfolio within that particular mutual fund. So he decides which stock to buy, which bond to buy, which security to buy, and he tries to balance it depending on the external and the internal environment. So the first one, the equity or the growth funds, these typically invest in stocks, and depending on the market capitalization, they could be large cap, mid cap, small cap, or a combination of all of these called as multi-cap funds. Then you have the fixed income funds, which involve investments in debt instruments like bonds. these are relatively safer as compared to your equity funds. Then you have a mix of your equity plus your debt funds, which are typically hybrid funds or mixed funds. Then you have index funds, which are passively managed, because the fund manager basically does not try to beat the market. He just tries to tag it to a particular market index, like for example the Nifty 50. He invests in the top 50 companies that are available in Nifty, and he just lets the fund grow as per the Nifty. So these are called as passive funds. Then you have others like money market funds, which are usually more liquid, and these are for short-term or ultra-short-term investments. Then you also have themed funds. These could be particularly on a particular sector in the market. For example, there could be a pharma themed fund wherein all your money that you invest could go into pharma stocks and so on. So these are a few of the common types of mutual funds that are available. Probably for starters, it's a good idea to go in for an index fund, or probably a mix of an equity or a fixed income fund. So these three would be your pick if you're looking at a good form of investment in mutual funds. If you're looking for a short-term investment, then probably the money market fund would be a better option for you. A few things that you should consider before you start putting in your money in mutual funds. One is who the fund manager of this particular fund is, and also the company that manages it. Look at the history of the performance of this particular company or the fund manager. The performance of the fund itself, so there could be multiple funds under a particular manager, but every fund might be performing differently as compared to the others. So also look at the historical performance. You would get this data on a 1-year basis, a 2-year basis, 3-year basis, and also right from inception of the fund. So do have a look at this as well. Also have a look at the different fees that are involved, because mutual funds are not entirely zero fee investments. There would be something called as an expense ratio, which is the amount that you would be paying to the company for them to manage the funds. There is also something called as exit load. In case you are prematurely exiting a particular mutual fund, which could be typically within a year of your investment, then you will have to pay a small percentage of whatever you've invested as an exit load. So do have a look at that as well. So without saying it, naturally makes more sense to go for funds that have low expense ratio and also low exit load. Also, like we discussed in the last video, there are two options that you have for investment. One could be a systematic investment plan, wherein you do repetitive investments at a particular frequency, and also you have lump sum investments where you can put a large amount of money at a single point of time. Now we definitely have to look at pros and cons of mutual funds as compared to the other investment classes that we will be looking at in a few of the upcoming videos as well. Important pros, like we discussed, it is an important tool for diversification. There is no significant expertise needed for you to go and invest in mutual funds, because you are not directly picking the stocks, you're not directly picking the bonds, or you're not doing anything directly. There is somebody who is an experienced fund manager who's actually doing this for you. There are wide choices of investment tenure. You can start with as short as a week of an investment to go in for a lifetime investment as well. There's a low capital requirement. Most of these funds require probably about 500 or sometimes even 100 rupees for you to just start an investment. Liquidity is a good option here, because if you go for a short term or an ultra short term fund, you can get the cash the very next day itself. And mutual funds are also tax saving, but these are limited only to the ELSS type funds, which are the equity linked savings scheme funds, which are typically locked in for a period of 3 years. On the con side, you have, since these are predominantly linked to the markets, at least the equity or the growth or the index funds, they are predominantly linked to the market, which means the returns and the risk could be fluctuating. The expenses involved, like we discussed, it is not a zero fee investment. There is a small amount of expense that is involved, so that is a con. Active management issues, because you are not directly in control of whatever you're buying in terms of the stocks or the securities. There is somebody else who is doing it for you. This could be a good thing if you're a beginner, but once you become a pro, then probably this is not such a good thing, because you may be a better person to pick the right stocks and the right securities as compared to the fund manager. There is no intraday trading possibility that is available, because whatever orders are placed will be as per the cutoff time for that particular day for a mutual fund. So which means that you cannot buy a fund in the morning and immediately sell it off in the evening once you make a profit. So that is not possible. There is a lock-in period for a few of the funds, like we discussed. For the tax saving funds, there is a lock-in period of 3 years. So that could be a con here. There is a possibility of dilution of profits because that comes with diversification. Once you diversify too much and you put more of your money in low risk investments, there is a chance that your profits can also be diluted. This applies for any other investment instruments as well. Finally, when we end this video, also looking at how do you actually purchase mutual fund units. So what I personally do is I purchase it on an application called the Coin by Zerodha. This is not an advice for you, but I find this very convenient to buy and sell mutual funds. There are multiple apps available. Various banking agencies, they have their own demat accounts and they have their own management services. So you can pick any of these, but in short, this is what you will find when you search for any particular fund. On top, you will see the name of the fund, the type of fund. Here you can see it is a growth fund. It belongs to equity and it's a large cap fund. You will find the current price of a particular unit, which is shown here. Roughly about 50 rupees per unit is the price. You will also see the historical performance. What is shown here is that the last 1 year performance has been offering a profit of roughly about 15% for this particular fund. You will also find other details like the minimal investment that is required for this particular fund. Here it is 5,000. You will also see the size of this fund, the asset under management, which is basically how many crores of rupees are being managed by this particular fund. Like I said, there is an exit load. There is also an expense ratio. So this is probably a little too high. You will find funds that have lower exit loads and lower expense ratios as well. And on the right side, you will see the historical performance again in a graphical representation from the point of inception of the fund till today. And finally, you will see two options. One, you can buy in the form of a lump sum investment, or you can do an SIP. So this is how most of your mutual fund descriptions will look like. So you can always compare different funds and go for whichever suits you the best. So just to close this video, always ensure that you look at all these parameters before you really jump into buying a mutual fund, and make sure you choose your funds wisely. Thank you very much for watching this video, and like I said, in the upcoming videos we will have a look at the other different asset classes also, and we will create a few more videos in the money series in the videos to come. So if you did like this video, please do click on the like button, leave a comment below, also share this to your friends, and if you have not already subscribed to our channel, please do click on subscribe and also the bell icon right next to it so that you get our notifications. Thank you very much and stay safe.